Well, good afternoon, everybody, and welcome to the latest in Australian Catholic Super's webinar series. Today, we'll be talking all things retirement planning, and joining me today will be Phil Johnson, one of our financial planners. Also joining us today will be Justin Colley, who will be monitoring the chat box. So for those of you that do have questions, please feel free just to type them into the chat box, and I'll circle back to him with Phil at the end of the session just to ensure that there are no outstanding questions. Firstly, I'd just like to do an acknowledgement of country. I would like to acknowledge the traditional custodians of the land on which I work and live and recognise their continuing connection to land, water and community. I pay respects to elders past, present and emerging. And a reminder today that we are live streaming on Facebook, and this is being recorded and will be available from around mid next week on YouTube for those that wish to hear certain sections or the whole presentation perhaps again. It will be made available. And just another reminder that today, naturally enough, is going to be general advice. For those that do need individual advice and more specific help, we will talk about ways you're able to get that if need be. We'll start with retirement goals, because retirement goals traditionally have been travelling, more family time, and by travelling I'd speak about cruising. It may mean simply more leisure time, and that may be gardening or camping or theatre or whatever it may be. But it is fair to say over the last couple of years, the activity for retirees has changed substantially due to COVID. So for obvious reasons, cruising is no longer as desirable as it once was, and travel has been somewhat restricted. Nevertheless, everyone's still going to have retirement goals and therefore needs to give thought to what they are, and also needs to give even more thought to how they're to be funded. So that's fundamentally what we'll be talking about today. So whatever goals you may have, you will certainly have them, but the nature of those goals and what you're able to do, particularly in the short term, may be slightly different to what you anticipated several years ago. The question that comes up a lot, though, for many people as they approach retirement is the obvious question, which is, how much super do I have and how much will I need? In terms of what you have, to find out how much you have is pretty straightforward. With ourselves, you would simply go to the portal and you would look it up, or you would use the phone app and look it up, or you could simply call the call centre and look it up. And why this is so important is to ensure that your employer is making the contributions they are required to make. So it's very important that people know the details of their superannuation, not just on the accumulation side, but also on the insurance side, because the insurance side's often forgotten about until it's actually needed. So bear that in mind too, and just if you do get a chance, have a look at those insurance amounts you've got and just ensure that they are adequate. So the question that comes up, and it come up with Phil and it comes up with myself whenever we present, is how much money do I need? And there are all sorts of numbers that are thrown around in terms of how much money am I going to need to spend in retirement and the like. And it will vary depending on what lifestyle you're seeking, and also often what sort of balance you've got. However, to provide some assistance, ASFA, or the Australian Superannuation Fund Association, has tried to come up with some numbers to give people an indication of how much they would need in order to lead what they call a modest or a comfortable lifestyle. And I'll speak a little bit more about what that entails in a moment, but just for now, this assumes you go into retirement debt-free. So if we have a look at that, you can see there the full age pension for a single is a little over 25,000 and just under 38,000 for a couple. And the ASFA modest expectation around what income you would need is only a little above that. So for a single, as you can see there, a bit under 29,000, and for a couple, 41,500 roughly. And the comfortable end of the scale, you can see there, a bit under 64,000 for a couple and mid-40s for a single. So this is as helpful as a single figure can be, given that we're trying to cover everyone from, you know, Hobart to Cooktown to Broome, and down to Perth and Margaret River and everything in between. So it is an impossible task to try and cover everyone in the nation and say, this is roughly how much you will need for a modest or comfortable retirement. But it is the best attempt we've seen yet to give people an idea. And we do encourage people to have a look at the ASFA website and to download the report. And the detail you will see is included in this table. So you'll get a real indication of what we mean by modest and what we mean by comfortable. Obviously, this stuff is subjective. By its very, very nature, it has to be subjective. I mean, if you have a look there, you know, reasonable car versus an older, less reliable car, bottled wine versus cask wine, which is an odd distinction really given how cheap bottled wine can be. You know, good clothes versus reasonable clothes. So as I say, have a read of it and treat it as a very good indicative approach to how much you will need and how much you will spend in retirement. Because a lot of people underestimate, I think, how much they're going to spend in retirement. When we look at retirement and we look at preparing for retirement, we shouldn't just be talking about superannuation necessarily. And this is where I'll ask Phil to make some comments as a planner, because one of the essential jobs of planning is not just to consider your superannuation monies, it's to consider all your resources effectively and how that's going to be used to get you through to life expectancy and beyond. So Phil, can I ask you just to speak just about the approach you take with regard to this holistic view?
Yeah, okay, thanks very much, Wayne, and good afternoon, everybody. Yeah, I mean, this slide's just trying to point out, as Wayne said, that when we sit down as financial planners to talk to people about how they're going to fund their retirement, it's not necessarily just about their super. There can be other assets that people are holding that may be used to help fund their retirement, and you know, some of the common ones are just listed on this slide. Sometimes people have cash which they may have saved, or they may have received some sort of lump sum from an inheritance or something like that, and they're looking to help to talk about how that might help fund their retirement. Another common one is property. So sometimes people are, have investment properties that they may be planning on using the rent to help fund their retirement, or maybe they're planning on selling it to help fund their retirement. The other one there is the family home, and whilst as financial planners we're not we're acknowledging that people need somewhere to live, so you may not be wanting to sell your home in order to when you fund your retirement, because you need somewhere to live. But more and more often people are talking to us about downsizing, and for a variety of reasons. It could be that the house is just too big now, or it might just be that yeah, it's always been part of the plan to sell probably the most valuable asset you have, buy a smaller home, and use some of the capital that you create from doing that in order to help fund the retirement. So yeah, look, the approach is always to look at all the assets as a total and see how we can help in that regard.
Thanks, Phil. And one of the obvious benefits when you're saving towards retirement with superannuation is essentially the tax. And just to cover what that tax is, when you're in the accumulation phase or the superannuation phase, earnings are taxed up to 15%. We say up to 15% because there are imputation credits that can be enjoyed by the fund. So it's often less than that, but it can be up to that. Likewise, when you're in what we call the transition to retirement pension phase, which is where you're working, but you're drawing back on your money as well. And we'll speak a little bit about that situation as we go through the presentation. But once you fully retire and you're over 60, you will, and you're in the allocated pension, and you're drawing down a regular income, you will be in a zero tax environment. So that's essentially why superannuation and moving to the account-based pension in retirement is so effective and so widely used. Tax-wise, it's a very, very hard thing to beat, quite frankly. So you can understand the popularity of using these structures. Which leads us on to the various age brackets where the tax can be different. And Phil, if I can ask you to speak particularly with regard to the 58-59 bracket and the 60-64 bracket, when you're talking about drawing back on your money, because I'm sure there's a bit of confusion, particularly in that pre-68 bracket.
Yeah, that's right, Wayne. So whilst tax superannuation can be very tax effective, there's a few conditions around what happens in regards to tax, which is what this slide talks about. So this is tax, like Wayne said, when you withdraw. Taking the age group 58 to 59. Now, why those ages? That's the first thing. Now, that is listed at those ages because that's, for most people, that's if you're going to be able to access your super, that's probably the earliest ages. It all depends on something called your preservation age, which I think there might be a slide about coming up a little bit later, but basically reasons why the government will let you access your super. So whilst you may be able to access your super at between 58 and 59, from a tax perspective, which is what we're kind of focusing here at the moment on, superannuation payments can be taxed when you're taking your money out before 60 is probably the simplest way of saying it, actually. Whilst it may be accessible, it's definitely, you must consider what the tax implications of drawing the money out before 60 are. Fortunately, things get a little bit simpler well, more tax effective after 60, because after 60 the pension payments are tax-free. So if you draw, or pension payments or withdrawals from super are tax-free after age 60. And that applies, well, basically all the way through from 60. The reason why we've categorised this, the 60 to 64 and then the 65 plus, is not because the tax is different on the withdrawal. It's because people aged 60 to 64 don't have the same access to their super as a 65-year-old. And again, once again, in simple terms, people age 65 are able to access the super without any restrictions. People aged between 60 and 64 may be able to access their super. Once again, coming back to those conditions of release, which I started to talk about a little bit earlier. So yes, I think the basic message is after 60, it's tax-free. Certainly be careful before 60 in terms of tax, but there's also additional requirements in terms of being able to access the super itself, depending on the age.
Thank you, Phil. And just speaking about how much money is going to be going into your superannuation account via the employer, you can see in front of you, these are the mandated requirements. So this is what we refer to when we say SG contributions, so superannuation guarantee contributions. And as you can see, they're moving their way up to 12. We're currently in the 10% bracket, moving to 10.5 this year, and we'll enjoy those steady increases all the way through to 2025. At this stage, as far as I'm aware, there are no proposed changes to go beyond that, but I'm sure it'll remain a hot topic because many people have suggested we need to get those levels up around the mid-teens. So it's a watch this space, but in the short term, at least, we can see we're going to have increasing contributions coming from our employers and going into our super funds. In terms of salary sacrifice, one of the most appealing things about salary sacrifice is boosting your super, but by doing so, reducing effectively the tax you're going to pay. So on the right, you can see what tax would be charged if you had your salary and wages sent to your bank account as per normal. Whereas if you were salary sacrificing that amount of money, it would simply be taxed at 15%. So if we have a look at the typical wage bracket there of 45,000 to 120,000, if you ask payroll to send everything to your bank account, you'll be paying the top marginal rate of 32.5%. Whereas if you asked for some proportion of that money to be salary sacrificed, it would be taxed at 15%, hence a 17.5% tax saving. Now, obviously, you can't access the money until you reach what we call preservation age and you satisfy a release condition. But nevertheless, it's a very good way to top up your superannuation, particularly later in your working life, where you will be accessing the money fairly soon. And we've got an example here, and I'll ask Bill just to walk through this example as he would with many clients. And you can see here just what happens when you choose to salary sacrifice through additional contributions, and what happens on the income tax side and just the savings that can be had. Phil, if I can ask you just to speak to this.
Yeah, sure, Wayne. So yeah, this table's just giving us a little example of someone who is earning $100,000 per year and what the impact of salary sacrifice is of salary sacrificing 5% of their salary to super. And so if you just sort of work your way through the table, you can sort of see that on the left-hand side of the or the center column, I guess, you can see that that's the existing situation where the people are not making any additional contributions. And then on the right-hand side, they've salary sacrificed $192 per fortnight from their pre-tax salary. So what the impact of that is that it because it's coming out of your pre-tax salary, it reduces your taxable income. And so you can see there that this person's had their taxable income reduced from $3,846 to $2,653. And I think most people sort of understand the concept. Well, if your taxable income is lower, then you're going to pay less tax. However, the other consequence is that you will receive a little bit less take-home pay. And once again, the example shows that there is a reduction there. What it tells you, it's $127 per fortnight less money in your take-home pay. However, you do end up, as a result of doing this, this person has ended up with a tax saving, as it's listed down in the bottom row of the table, of $66 per fortnight. So, and I mean, this probably highlights, one of the a bit of a recurring feature of a lot of things about regular payments into super and things like this. $66 per fortnight doesn't sound like a lot, but if you're doing it for a long period of time, it builds up. Table tells you $1,716 per year, $17,160 over 10 years. But just remember as well, that's not just money that you've saved income tax on. That's actually money that's been put into super, and then, like Wayne has been talking about in previous slides, that money is also invested in a tax effective manner for growth as well. So all these benefits all come together and help build a substantial amount over a period of time.
Thanks, Phil. And when we speak about salary sacrifice, we're talking about concessional contributions. So just to clarify what we mean by concessional contributions, we're talking about contributions that are taxed concessionally. hence the name. So we're talking about employer contributions, SG, salary sacrifice, additional employer contributions, and even those contributions that you may contribute and you later claim a tax deduction for. So there is a cap on the amount you can contribute in this way. And for this financial year, it's $27,500. In the previous financial year, it was $25,000. And a number of years ago, the government also introduced a scheme whereby if your balance was under $500,000, you could use what was called the unused proportion in the cap. So if you haven't maximised your concessional contribution cap over the last several years and your balance was less than 500,000, then you can play what we would call catch-up footy, so to speak, whereby you could contribute more than the 27,500 for this financial year. We've got quite a lot of information on this on the website, and there is a lot of information freely available on concessional contributions and using the unused cap. So for those that need help with that or are thinking of doing that, please by all means let us know and we'll be able to provide further assistance. When we talk about non-concessional contributions, we're talking now about contributions where funds have essentially gone from employer to your bank account and you've paid your full marginal tax rate on the money. So that they aren't concessionally taxed, hence the name, non-concessional contributions. So it's money fundamentally coming from your bank account. And as you can see there, if you're under 67 years of age, you've got a much higher cap compared to concessional, whereby you can put in up to $110,000 per annum, or you can use what we call this 3-year provisioning, whereby you could put up to $330,000 in a single year. However, it would preclude you from putting in anything in year 2 and year 3. You've effectively used up your 3-year allowance, if you like, in a single year. For those, as you can see, they're aged between 67 and 74, 110,000 is all you can put in. Currently, we are subject to a work test, although that work test is likely to go for the coming financial year. And for those over 75, there isn't the ability to make further contributions. The thinking is there that by that age, you're well and truly in what we would call the drawdown phase. So, it's a time to be enjoying your money rather than accumulating it, if you like. Other ways to contribute, and these are becoming particularly popular and of more interest. And I'll ask Phil to speak about particularly downsizer and a little bit about spouse contribution. We always do encourage people to consolidate their superannuation where appropriate. The main caveat on that being, as I mentioned earlier, understand your insurances, because there could be insurance ramifications if you're rolling from one super fund to another. You may unknowingly be actually cancelling insurance arrangements, which could be hard to reinstate. So just bear that in mind. But Phil, if I can ask you to speak about downsizer in particular as an option for people to top up their super.
Yeah, sure, Wayne. Yeah, so, and I think this sort of, I refer back to what I said about 10 minutes ago. Where I said that some people, more and more people are using downsizing their house as a means of financing part of their retirement. So this is definitely a relevant and probably important thing that the government has done in the last few years in terms of this rule. So downsizer contribution allows people that are over 65, subject to a few rules, the main one being that the property you're selling has got to be in your home for at least 10 years. If you fit the eligibility criteria, then you're actually able to make what's called a downsizer contribution, and that limit is $300,000 per person. So that means, I mean, a couple can effectively make actually up to $600,000 $100,000. And the other thing which quite often surprises people when I tell them is that the downsizer contribution is not part of the non-concessional contributions that Wayne was just talking about. So Wayne was talking about 330,000 over a 3-year period. That is an additional amount over and above the downsizer contribution. So I'm hoping people can get a sense of that. The ability to put money into superannuation is, it's actually very large. Yeah, so that's basically the broad principles of how it works. Then on regards to spouse contributions, yes, I mean you can potentially contribute into your spouse's super as well. There isn't a potential additional benefit in doing that, apart from the obvious benefit to your spouse of putting money in there, which is that you may be able to claim a tax deduction by doing such a contribution. I think the maximum, it's not a tax deduction, actually it's a tax rebate. So up to $540 your tax bill can be reduced by $540 if you make that type of contribution. There's a few rules attached to it. The main sort of rules are that the spouse, to be able to get the rebate, the spouse I think must be earning less than $40,000, and to get the full 540, I think the spouse has got to be earning less than $37,000. Yep.
Thank you, Phil. And just in terms of when you can access your superannuation, we referred to it in an earlier slide to that age bracket of 58 and 59, that pre-60 age group. And you can see here, because of the way preservation age is moving up, we're still in this transition phase, if you like, whereas if you were born in the early to mid 60s, you won't have a preservation age at 60, but once you were born after mid 64, you will. So this will naturally come out of the system over the next few years as people reach these ages, and were obviously born after mid 64. But for now, we still have this situation where you could have a preservation age under 60. So you can see there, you can get your money, but there are other considerations because there can be tax implications pre-60. Whereas once you get to 60, if you cease your employment arrangement, you move to the allocated pension, then things become very, very simple and everything becomes tax-free, whether you're taking pension payments or lump sums. It all becomes, as I say, a far simpler situation. And once you reach 65, you have full access to your super, whether you are working or not. So it becomes even more flexible. As I mentioned before, quite a few people will ask, if I set up an allocated pension and I'm receiving regular monthly payments, for example, what happens if I need to suddenly update the car or the kitchen or whatever it may be? Can I take a lump sum? The simple answer is yes, you can. So when you're drawing down on your allocated pension or your account-based pension, call it what you will, there is no upper limit on how much you can take out. So you can take out your regular income stream payments once a month. And if anything does occur where you need suddenly 10,000 or 15,000 or whatever it may be, absolutely you can get that money and you can receive that money tax-free. So the account-based pension is a very, very flexible arrangement and suits the vast array of pensioners and those heading into retirement. If we talk about the move from superannuation to pension, think of it as in superannuation, you're effectively in the accumulation phase where you've got money coming in and the earnings are taxed, as I mentioned, up to 15%. Whereas once you go into the pension phase and you get beyond 60, as we've mentioned, and you meet those release conditions, it's completely tax-free. And you're now in what we call drawdown phase. So when you're in the pension account, it's worth noting you can't add money to it as such. In order to add to it, you would actually need to have a superannuation account and add to that, which you could then subsequently convert to a pension, but you can't add money to a pension as such. But if you are in a situation where you're in a pension arrangement and, for example, you receive a large inheritance and you want to add further money to superannuation and you're eligible to, you certainly can. It's just we use a superannuation account to do so. And there are ways to then consolidate the funds if that applies to yourself. If it does, what I'd say is it would be worth speaking with one of the planners and getting a little bit of advice around that. When we talk about transitioning to retirement, we talk about this arrangement whereby you're able to not only contribute to super via salary sacrifice, but you're also able to draw money out. Now, you might say, why would you want to contribute to superannuation and at the same time draw money out? Well, essentially, because you're substituting your marginal tax rate for a 15% tax rate on the contributions in. And if you're over 60, you're drawing money out of your, what we call transition to retirement pension account at zero tax. So it's essentially a tax strategy. There are limits to it, however, and as you can see there, the maximum you can draw down is 10%. And there are, of course, limits on how much you can, as we've seen, salary sacrifice and get into superannuation via the concessional cap. So a very effective strategy for those particularly over 60 and still working. So again, if this is you, it may well be worth getting a little bit of help or doing a bit of reading up on the TTR pension arrangement and how it can save you money and help build up your balance. When we talk about full retirement and actually exiting the workplace, we're now talking about the allocated pension or the account-based pension. And as I mentioned earlier, this is simply an arrangement whereby if you're over 60, you'll be paying no tax. And at the moment, what's made it complicated is normally with the allocated pension, there's a minimum requirement you must take out. And if you're under 65, it's 4%. And if you're 65 and up, it's 5%, and it goes up in various steps as you get older. But in the current financial year, the government has provided a 50% reduction in that minimum. And they've done this essentially because people weren't spending money like they traditionally have due to largely the COVID restrictions. So it has helped people preserve their balances, but it's also given them greater flexibility, if you like, to draw down less than the traditional requirement, which will maintain a larger lump sum, which hopefully will go some way towards abating longevity risk, which is a concern many have, that they could potentially run out of money, well into their retirement. I might just throw to Phil on this one. When he's explaining to clients and potential clients just around that reduction in the minimum that they now have access to and what that means for potentially longevity risk of their funds.
Yep, sure. Well, I think it's as you said, Wayne. They are able to draw less money out of their retirement savings. Now, I think the common experience is, like you said, Wayne, because of COVID, I haven't been able to. Clients might say I haven't been able to spend the money that I thought I was going to spend. So, I mean, a good example might be travel. They haven't been able to do the travel that they thought, and therefore they actually don't need as much money as what they thought they do, not at the moment. So the minimum payment is a requirement that you must take from the government. But if the government reduces the minimum and you actually don't need it because your spending is down, then that does mean you have got more money effectively left in your super, doesn't it? Which, once again, go back to all those principles we've been talking about. Tax effectively invested. If it's in an account-based pension, it's not going to be paying any tax. So you're able to keep your capital in a tax-friendly environment, invested for the long term, for longer. And so it's something that is designed, I guess, by the government in acknowledgement to try to help people preserve their capital a little bit longer, particularly given they don't need the money at the moment.
Thanks, Phil. And when we talk about where your money will be invested when you're in this allocated pension or account-based pension phase, there's essentially two options with Australian Catholic Super, as there are with many funds. So you've got what we call here retired choice, which means you can determine exactly where your money is invested. And specifically, that may mean you choose diversified portfolios, which are those listed on the left, which have a mixture of the various asset sectors, or you may choose the asset sectors themselves, which are listed on the right. And you can have as few of these as you wish, or as many of these as you wish, in whatever composition you choose. It is completely up to yourself. So for those in this allocated pension stage, they have complete control of where their money's invested. It is worth saying, though, many people don't actually want that choice and don't exercise that choice. So they use what we would call, or what we call retire smart, which is essentially a two-bucket approach whereby you've got a growth bucket and a cash bucket. And in the growth bucket, what the fund is trying to achieve is essentially the maximum growth possible while minimising the volatility. So it's taking that investment decision away from the member themselves, because they don't necessarily want to make that investment decision on specifically where the funds are invested. So neither's right nor wrong. It's just a question of what are you more comfortable with. If you wish to choose your portfolios, by all means do so. And likewise, for those that aren't comfortable too, there is, as I say, there is this retire smart option. And if we have a look at it diagrammatically, we can see there, so the growth assets essentially create the cash distributions, which go to your cash account, which thereby pay the pension payments. If there is excess cash distributions, then they would flow back into growth assets to subsequently provide more cash distributions. So hopefully I've explained that well. If not, as I say, we do, like all products and investment options, we do have a lot of information available on the website for those that wish to learn more about this process. But this is typically what planners would talk about when setting you up into retirement and through retirement. And the reason we talk so much about portfolio choice is because of this, what we call longevity risk, which is a very polite way of saying, as I mentioned before, the risk of running out of money when you can least afford to. So running out of money as you approach life expectancy, or even as you exceed life expectancy. So it is a very real concern with many, many Australians that they're going to run out of money late in their life and be solely dependent on the age pension. And we will come to age pension shortly. So that's why those investment decisions are so important. The question often comes up on the left-hand side, as you can see there, when can I retire? Which is, strangely enough, you can retire at any age. If you're wealthy enough, you can be retired at 25. But usually people, when they say, when can I retire, what they're actually asking is, when can I access my superannuation, which is a different question. So if you equate the two and you say, okay, when can I access my superannuation? It's essentially when you have, when you've reached those preservation ages we've spoken of, you've met a condition of release, which typically means you've ceased working or changed employer, and you've got enough. Now, how do you know you've got enough? Well, you can use our projection tool on the website, or you can use many, many others. Money Smart, in particular, on the ASIC website is very good as well, that simply project the lump sum you've got and give you an indication of how long it will last. So that question essentially is for yourself in terms of how much do you think you'll need, given we've looked at what ASPA think is adequate for modest and comfortable lifestyles. And the other factor that we can't ignore is the COVID situation, which means for a lot of people, as Phil mentioned earlier, and as I did likewise, people aren't spending quite like they did pre-COVID because of the travel restrictions and the like. So very important considerations here, and things that a planner will typically want to speak to you about in depth if you are seeking advice. We've got a situation here with Gary and Mary, and I'll ask Phil to talk through this scenario, because it's a quite a typical scenario where you've got a couple, as you can see there, aged 65, $300,000 each. They own their home, so they're debt-free as far as the home's concerned. Their income requirements are at that comfortable level, so that 63,000 combined. They don't have assets essentially outside of super. We're assuming inflation at 2.5%, a rate of return pretty modest of 5%. We're assuming a rising living standards, as you say, of 2.5 to help offset the inflation effect. And we're displaying everything in present value, so people don't need to think of what we're going to show in future value, and therefore there is no need to discount it back to today's dollars. It is expressed in today's dollars. So Phil, if I can just ask you to speak to this slide for the couple we've just looked at.
Yeah, sure. Thanks, Wayne. Just a couple of comments, but about the whole subject of longevity, which is what this graph's really trying to help us with. I think that we talked about those ASPA figures, and the important thing to remember about those figures are they are averages. Wayne talked about that. I just want to point out that as financial planners, when we're sitting down with somebody, we're actually sitting down and working out or working with that client to try to determine what their level of spending is. This graph uses the ASPA standard of $63,000. That may well be true for many people. It's not obviously true for everyone because it's just simply an average. So our approach, financial planners, we're tailoring our scenarios for you. This is how we think it's going to work in your situation. The other thing is that whilst there is many versions of retirement planning software trying to give you an idea of how long your money is going to last, as we are as well, is that we're using a fairly sophisticated piece of software which actually, once again, is able to tailor it pretty precisely for the individual client situation. The big thing is, particularly in this graph, is that in this analysis is it takes into account how much age pension you might be able to receive, whereas a lot of the more simplistic analysis that you might be able to see on the internet and things like that, they don't take into account how much you might receive from the government in age pension. So anyway, I mean, I think the point is, financial planners, we're doing trying to do a tailored situation of a tailored answer to what your situation is in terms of retirement affordability. This graph as you can see, is showing that remember the couple had $300,000 each in super. So that's where the assets are showing on the left-hand side. They start off with $600,000, and their retirement capital, and that's the shaded area of the graph. How long does it last? It's showing that it lasts until just about 92 or 93 years old. So it's lasting a long time, isn't it? And that, when we show people something like this, quite often they are surprised how long the money actually lasts. And it's, as you're about to see, if we probably go to the next slide, Wayne, it's in part because of the effect of the age pension on funding your retirement. And this particular graph is showing that, because whilst the last graph was looking at your assets, this graph is looking at your income when you retire. So these people, you can probably see that there's a horizontal red line on the top of the graph. That's the $63,000 a year they need to live on. Then you can see those different coloured bars. There's a purple bar and a blue bar. The purple bar is drawing down money from an account-based pension or an allocated pension, drawing their money out of their super. But you can also see after the second year, the blue bars start to appear, and that is actually the age pension. And as you can see, the age pension in this case is actually a significant part of their funding. A lot of the time, as you just going across the graph, you can see more than half the retirement funding each year is actually coming from the government in the form of the age pension. And that's why why people get surprised about how long the money is actually going to last.
Thank you, Bill. And this leads us obviously to age pension, and people are very, very interested when we talk about age pension in terms of how much they will receive and what are the limits. So we'll talk specifically about that. So to be eligible, there's an age requirement, there's a residency requirement, there's an asset and an income test, and we'll have a look at that, and we'll also have a look at the payments that will be made. So if we have a look at the age and eligibility, you can see there that, and you're probably aware that the days of age pension kicking in at 65 are largely done. As you can see, we're moving towards 67. At this point, there's no, as far as I'm aware, there's no intention to have that raised even further. Years ago, there was a proposal, but it got shot down fairly quickly. So we would expect it to remain at 67 for some time. If we have a look at the assets test, you can see there, and I'll concentrate particularly on the amber part. So for a single, they can have assets outside of the home of up to $593,000 and still receive some age pension based on the assets test. Similarly, for a single person who doesn't own a home, they can have assets of nearly $810,000 and still get some form of age pension based on the assets test. If we have a look at couples, we can see the amounts are slightly different. So a couple homeowner, which is probably the typical situation, can have assets outside of the family home of $891,500 before they lose access to the age pension. So the obvious question is, well, what assets are you talking about? We're talking about everything. Think of it as everything outside of the family home. So, and that includes your superannuation. And the thinking being is, if you're exceeding these amounts, you probably are not in need of age pension. Now, that's a government view, not necessarily Phil's view or my view, but that is the government approach in terms of reasonableness, if you like. So they do apply this reasonableness test. So, for example, a couple that don't own their home, that have assets of exceeding, 1.108 million, they would say they actually probably don't need age pension. They've got enough resources to house themselves and provide for themselves adequately in retirement. If we have a look at the income test, slightly different. And it's fair to say most people are impacted more by the assets test than the income test. But similarly, we talk about this reasonableness. So for a single person, they can earn, and we'll talk annually, they can have nearly $55,000 coming in per year before they lose access to the age pension. And a couple will lose access to age pension once they hit $84,167. Again, the argument from the government would be if you're receiving income of $84,000 and beyond as a couple, you probably don't need age pension to sustain yourself. So they're the limits. Now, for most people, they do qualify for at least part age pension. So if I think about my own parents, they certainly don't qualify for full age pension, but they qualify for part age pension. They don't exceed, and they're not in those amber ranges to exceed the limits. The other point to note here is the government will take the test that minimises the age pension payment to yourself. It's worth noting that. So they're essentially guardians of public money. So their tendency is to be less generous rather than more when it comes to these tests. So think of it as they are trying to guard the funds. So they're going to apply the test that provides you with the lower age pension amount. Phil, have I covered that adequately? Is there anything I've missed on that?
No, I think that's fine, Wayne. It's good.
Okay, because I know there's always a lot of questions around age pension in terms of the amounts. So you can see there, and these are maximums. So if you fully qualify for a single, 25,155, for the couple arrangement, 18,962 each person or combined, just under 38,000, or, which is increasingly happening, a couple arrangement whereby due to ill health they're apart. So one could be, for example, in an aged care facility, $25,155 each. The Commonwealth Seniors Health Card is also one of those things that people were very, very often interested in when they go into these retirement years. So there are requirements as well around this. So you can see the qualifiers there on the left. You've reached age pension age, and you've also got an income limit on how much you can be receiving to be eligible for that seniors healthcare card. And again, think of this reasonableness test applying. So you do meet an income test. It will mean cheaper medicines. It will mean bulk bill doctor visits, and there's obviously a residency requirement. People often confuse the Commonwealth card with what's available at state level. So the state level discount cards apply to things such as utilities and public transport. And the reason they do is because these are areas of state government responsibility and not Commonwealth. So that's why you do have these two cards typically in retirement. So it's not to make life more complicated than it need be. It's a question of jurisdiction and jurisdictional limits. So that's why that is. I might get Phil to talk about estate planning. This is increasingly an obvious topic that we need to address, and people often don't choose to talk about and should. Phil, can I ask you just to talk to these key points, if you would?
Yeah, sure. Yeah, I mean, this presentation so far has, talking about retirement, building for retirement, spending money during retirement, but of course there's another part of life which is about estate planning, and in particular the issue of how you'd like your assets to pass you die, and so it's important to plan for this aspect of life as well, and there's a couple of key areas. I should say to everybody that financial planners, we're not actually we're not legal professionals, and so things like wills and power of attorney, which are very important, we don't actually provide what's called personal advice on it, but we do recommend that people speak to their solicitor about what they want to do in that regard. We do actually have a referral arrangement to solicitors for that. Yeah, I think most people know particularly about what a will is and the importance of that. The power of attorney, and in particular the enduring power of attorney, is something that can be very useful for families when somebody is unable to make decisions for themselves. And of course, the other point that's been made on the slide is beneficiaries of superannuation is obviously also very important. I mean, your super generally turns out to be, for most people, the second biggest asset they own after their home. And once again, it's important to talk and think about how you want that money to be passed on to others. And in the case of the superannuation beneficiaries, there's discussions that we have with people not only about who they wish to make the beneficiary, and superannuation does have some very specific rules about who can be the beneficiary, but also the tax implications, and potentially, as financial planners, even Centrelink implications of who you make the beneficiary. So yeah, so very important subject, and it's always a part of the discussion that we will have with a client when we're sitting down with them.
Thanks, Phil. And that also leads us somewhat to aged care. Again, a difficult subject, and not one people necessarily readily want to speak about, and made more complicated because often the person in question who's needing the care is not often the person seeking the advice. That's often the children of the person who's in need of the care. So Phil, can I just ask you to speak briefly to just some of the situations you see, just with regard to the members and ageing parents, perhaps?
Yeah, I think what you said was right. The majority of people that we're speaking to, if we're talking about aged care, it's actually not for themselves. It's for parents usually, and it can be a discussion on a number of different levels. It could be, I mean, yes, people are recognising that they may have to partially fund some of their parents' aged care requirements, and it could be a discussion around how to plan and how that's going to be funded. It could be a more specific question around sort of how what is the best option in terms of choosing aged care alternatives. By that I mean, I should be clear with everybody that we don't provide advice recommending an individual aged care facility, but what we can do is provide an analysis of a number of different alternative scenarios and the impact on the costs, the cash flow, what impact it might have on other things which are associated, such as the age pension and things like that. So that can be very helpful for clients.
Thanks, Phil. And if you could just speak more broadly, Phil, just on essentially how planners are able to assist, because these are difficult subjects. People often need, particularly with aged care, they need help with some urgency when it arises, but they often don't know where to turn.
Yeah, sure. So most of the things which are listed there, we've probably spoken about today, but probably a couple of things worth emphasising. It was mentioned on one of the slides, but probably the biggest single question I get is that question about how long will my money last? It's listed on this slide as well. Can I afford to retire? Like you said, Wayne, well, you can retire at any age you want. Can you afford it? Is another question, and that's that's a big thing that people really want to some assistance, and we are always very willing, happy to and experienced at helping people come up with the answer to that question. Yes. Because we're dealing with the rules of Centrelink and age pension every day as part of our jobs, we're very able and capable and have the tools to be able to help people work out the best way to get the maximum age pension and things like that. We've spoken about estate planning. Sometimes people are a little bit surprised that when they come and see us as financial planners working for Australian Catholic Super, to find out that we don't just advise on superannuation. It goes back again once to our earlier slides, doesn't about that holistic view. We generally take into account all the assets that somebody has when we're talking about making recommendations about their situation. There are some specific things that we can't provide advice about. However, we sit down and we talk to people about what we'll do in those sort of circumstances. And the other thing which is listed there, which also people aren't sometimes aware of, is that they think that because they are a member of Australian Catholic Super that they can receive advice from an advisor that works for that fund. However, we also advise people outside of the fund itself as well. So we're allowed to do that. And to be honest with you, particularly for couples, given that finances, when you're talking finances, you're usually talking about finances for a couple. I personally think it makes for a better conversation and a better result for the clients when you're taking into account both partners' situation.
Thanks, Phil. Yeah, just to extend on that, how can we help? In terms of general information, as I mentioned, the website's terrific. If you do have any further questions, by all means, let people such as myself know. I'm known as a regional manager. There's quite a few of us around in each state, so feel free to reach out. You've got the call centre you can access, you've got the website, you've got the portal, you've got the phone app. There is loads of information we can make available, and there's also, of course, the human touch if you wish to call the call centre. We do also have over the phone personal advice that can advise, as you can see there, on contributions, investment options, insurances, and transition to retirement arrangements. So there really is every resource available if you do have questions, and I would encourage everyone to reach out and make full use of those resources that are available. As Phil mentioned, and he's involved in what we would call the comprehensive advice, he's able to take a very broad view of your situation and consider assets well beyond your superannuation, as he mentioned, to ensure that you do have adequacy of finances all through your retirement and all the way up to life expectancy and beyond, because of course that's essentially what we're talking about, to meet those goals. And you may even have estate planning requirements. So as I say, yeah, resources are certainly available to assist. We do encourage people, and I know I mentioned this earlier, to get onto the member portal, because it does provide you with a very, very good snapshot of what you've got, and it is the gateway to all the resources that both Phil and I have spoken about. Similarly, the phone app. So if you haven't had a chance to download the phone app, please do. So at the touch of a screen, so to speak, you'll be able to get all your latest details. And of course, you'll be able to make a contribution, see your balance, change your investment options, work out your insurance needs, nominate beneficiaries, which is critically important, and many, many other things if you are accessing the portal and fully utilising that phone app. I'll now bring in Justin, if I may. Justin, if I can just refer to yourself, just to make sure there aren't any outstanding questions that have come through. We've been speaking now for a little over an hour, so if I can just pass over to you, that'd be terrific.
Thanks, Wayne and Phil. Thanks for the presentation this afternoon. There has been a number of questions to come through, actually. A few are on the same topic, so I'll sort of try and merge those together. But the first one goes back to when you're speaking about the bring forward rule for the post-tax contributions, the non-concessional contributions. It is, if you are 66, can you use the 3-year provision?
Phil, do you want to tackle that one?
Yeah, sure. So yes, the age limit on the bring forward rule is now 67. It was 65, so they have changed the rules. So the person that asked that question may not have been aware of that, but yes, it's now 67 for the bring forward rule. So if you're 66, it's still potentially available to you. Yes.
Great, thanks, Phil. The next one is, and I'll shoot off this one to Wayne. How does one work out their catch-up amount for concessional contributions?
Oh, okay. Well, I'm assuming you've got a balance under the 500,000 at the end of the financial year to be eligible, but it's essentially looking at how much of the contribution cap of the previous years you've used. So we're talking about employer contributions plus typically any salary sacrifice contributions that have been made. What's the remainder up to the limit? Now, if we're talking last financial year, it was 25,000. So let's assume you've got a $3,000 limit left. So you had 22,000 go into your fund concessionally in the previous financial year. What it means is you've got a $3,000 amount you can carry forward into this financial year, which can be added to the 27,500, bringing your concessional contribution cap to 30,500 in this current year. If you're a member of Australian Catholic Super, pardon me, and you're not sure how much concessional money you have had go into the fund in previous years, we can get that number for you. So please just ring us. And as I say, we'll be able to provide that number, assuming you've had no money go into other superannuation accounts.
Thanks, Wayne. Probably just one other thing I might add to that is you can also look on your MyGov account under the ATO section there, and it also has the contributions up to date of what you've put in for the financial year and the previous financial years as well.
Justin, sorry, Justin, I didn't mean to.
No, that's fine, Bill.
I was just keen to just mention to everybody as well that that rule about bringing what's called carry forward is the term that the government uses. That carry forward idea, it goes back to 2018-19, so it doesn't go back indefinitely, it is basically the idea it was you can carry forward up to 5 years worth of unused contribution. So we haven't reached 5 years yet because
only from the 18-19 years.
But I just thought that might be helpful for people to know that as well.
Thanks, Phil. And also the next question is the age pension test, is super included or not? Sorry, I never said.
Yes, it is. Yeah, in short.
Sorry, am I answering that one?
Yeah, oh, you take it, Phil.
Yeah, so sorry, Justin, is super counted?
Yeah, counted towards the assets test.
Towards the asset test. Okay, that's actually that's a really good question, because I mean it can be yes or no. It does depend on your circumstances, but a general answer is this: if you are of age pension age, so you've reached the age requirement for the age pension, then yes, it is counted as an asset. But I probably would just like to say to people, this is probably a good example of where a financial planner can help you. There is situations where both members of a couple aren't necessarily of age pension age, which means that now Centrelink do assess you as a couple. They look at both your assets. Okay, even if you're not of age pension, if one of you is not of age pension age, they'll still look at your total assets. But I'm sort of hoping that people might be able to see where I'm getting at, is that the spouse who has not yet reached the age pension age, the Centrelink rules are that money held in super for that person, they don't count.
Okay. Thank you. Wayne, I've got a number of questions around beneficiaries, so I'll just shoot them off to you quickly. The first one is nominating beneficiaries, that is my children. Do they need to be dependent, or can they be children who are independent?
Well, it depends on the type of nomination. So if it's a non-binding, yes. If it's a binding, however, and usually people want to know more about the binding nomination.
I was just going to say that's going to lead into the next question, Wayne, because the next question is the difference between both. So you might as well be on both.
Yeah, okay. So I'll start with that. A binding nomination effectively, as the name implies, it binds the trustee to direct the funds to who you've nominated. So for a binding nomination, you need to have what's called dependency. So dependency is spouse, can be adult children that are financially dependent, but essentially that's what we're talking about. Phil, do you want to add anything to? I think that's in summary.
It's talking about the types of nomination.
Yes.
Yeah.
So that's right. The three most common ones are spouse, like you said, children, and adult children, or younger children. That's another term. I think people know what I mean. Young, but the big difference there is actually the tax treatment. You can nominate adult children as beneficiaries of your super, but they may pay tax on the benefit. Whereas a spouse or a child under 18, they don't actually pay any tax, and that's a really good question as well, because that's another, because as I think people are starting to see, like a lot of things in super, it's not a simple answer. There may be, if you are concerned about the idea of your adult children paying large amounts of tax potentially on your superannuation benefit when you die, that's another thing that there may be strategies that a financial planner could help you with.
Just when you're talking about dying there, Phil, I've got a member who's asking what happens if a nominated beneficiary dies? What happens? Does it go to their estate?
That's a good question too, isn't it? No, actually, the nomination is actually void. So yes, that's actually a good example where it shows it's important you keep your beneficiary nominations up to date, because that would void it.
And just on that, also I've got a member asking how do they change from the non-binding to binding. All you need to do is complete a form and submit that with the fund, and we can do that for you. Just fill a couple more questions. Do you have an online calculator where a smaller amount is in super but a larger amount in real estate?
Now, I'm going to answer it in my financial planning perspective. The software we use is not available online for the clients to use. As a matter of fact, it's very specialised software. We actually have specialist people who operate the software for us. I think there is other funds that you might be able to, other tools on the actual website, which but I can see from your reaction they won't take that into account either.
Members can't see me at the moment, Phil, but now they can. I'm talking. So as Phil's saying, Phil can certainly look at that when he's meeting with you. But from a general calculator on the fund website as such, no, there's not. Ours are all just around the superannuation side of it. not taking into account real estate outside of your super. Just going back to the questions. Phil, this is a good one about financial advice and paying for it and changes. So the member has said, my issue with paying for financial advice. Advice is always very good, but life happens and things can change overnight. So advice no longer is applicable, and money paid for great advice, which is no longer applicable, is wasted. Sorry about the negativity, but is there anything you could add to that to put a positive spin on that?
So the person is saying the advice is good, but not applicable?
Because it changes overnight because things happen. So I guess...
because the world changes and the government keeps changing the rules and things like that. Is that the sort of the general...
Yes, and also personal circumstances, I guess, and things like that.
Well, I guess it kind of depends on how you want to look at that. I would actually say that because the world changes, that's why you do need to see a financial planner, because you may be missing out on opportunities as a result of those changes. And so, of course, if the rules change, the rules may well change again. I mean, look, unfortunately, we can't control that. But I would actually, I would probably argue that it's important that somebody sits down with the financial planner if they have had if the circumstances have changed. Now, I think that, look, I'm cognizant of the fact that yes, comprehensive advice, comes at a cost, and so I understand what this person's saying, but I think, well, all I can really say to you is this: to have the situation reviewed as a review client, there is a fee. It's $380. So for $380, the financial planner will sit down with you and determine with you if there's things that could be that you agree would be to your advantage to change. Now, if ultimately you and the financial planner don't think that it's worth changing anything as a result, then I guess the worst thing that's happened to you, you've paid $380. But that's, for that's also giving you a lot of peace of mind that the situation has been professionally considered. And so I think that in itself is worth a lot.
Thanks. Well, yes, and we all know things change overnight and things like that, but I guess you're putting in place structures that are in members' best interest. And what you just said then as well about the review, if things do change, people don't have to come in for a full new financial plan. It might just be tweaking something they've already done. So they wouldn't be up for the cost of a whole new plan, just the review.
Yeah, that's right. I mean, the way we charge is based, it's based broadly speaking on the work involved. If there's not a lot to do, it's going to be cheaper than if there's a lot of work to do.
Just swinging back to a question from earlier, the member has said, this is going back to about whether the nomination person has passed away. What happens if the member dies as well? And I guess really, if there's not a valid beneficiary on the system or recorded with the fund, we would exhaust all our investigations in looking to see who would be a valid beneficiary. We would look for children, or spouse, obviously, children and partners and so on. And at the end of the day, it'll end up at your estate. If we can't find a beneficiary, the fund wouldn't keep the money.
I think that's the important point, isn't it? The fund is not going to keep your money. The fund will act responsibly to try to find out what they believe is the best they can determine is what your intentions would be. Okay.
And I'm just going to wrap things up now there with questions. So just with one other, and I'll answer this one myself for you guys, is a member has asked about, is the presentation available to be downloaded? And also a second member has come online at 3 o'clock because they're in Queensland with the time differences and asking, is there going to be another seminar? Well, two points to that. First of all, you can register for these seminars. There's still 2 more next week. But as Wayne also said at the outset, we don't send out these presentations. However, they are recorded, and a recording will be on our website next week for this particular seminar, but it's also been live streamed on Facebook. So you could go back to Facebook now and watch a full replay through Facebook as soon as we finish in the coming minutes. So thank you, Wayne and Grant. Wayne and Phil, sorry, I'm having a shock here. So yeah, thank you, and thank God it's Friday afternoon. Have a good weekend. I'll leave it to you guys.
Thank you.
Thank you, everyone. Have a great weekend.
Yeah, you too.